The 1 minute kill shot is my go-to trading strategy that has turned me into an unprofitable trader into a trader who sticks to a boring strategy that works consistently. This trading strategy I'm going to teach you has taken me 3 years to create, and after 3 years I can confidently tell you this strategy works. I am now able to consistently turn over profitable days like this, and this every week. Subscribe for more content like this, and let's get into my favorite trading strategy, the 1 minute kill shot. I want to set some expectations and guidelines as we get into this trading strategy in this entire video. And I want to encourage you to stay to the end, because at the end of this video, we're going to actually be doing some live testing and live trading of this trading strategy, giving you a pre-analysis. How do we spot point of interest? How do we actually execute? How do we take profits and stop losses? And how do we trail our stops? So I'm going to give you the complete breakdown in this video, but I want to set the expectation first that this trading strategy is boring. If you're expecting trading to be this exciting thing that you're taking 5 to 10 trades a day, I want to burst your bubble right now and bring you back to reality. Is not trading. Trading is supposed to be boring. You're supposed to be sitting on your hands all day. You're supposed to be waiting for that proper setup. You're not taking a trade every single day. That's how you should be trading. So if that's what you're expecting here, go to a different video. This isn't for you, because I'm going to teach you the right way to trade. Now, I want to encourage you, if this trading strategy is getting boring, you're doing the right thing. Now, I want to also say, don't strategy hop if it starts to get boring, and try to find the next one that's working even better or bigger P&Ls. If you have something that's small, consistent profits compound over time, and you're going to be able to get bigger P&Ls if you're willing to start with small, consistent profits. Remember, it's taken me 3 years to get where I'm at today. And I'm hoping I can accelerate your trading journey by giving you this video so you don't have to go through the pain that I did over the last 3 years. You are your biggest enemy when it comes to day trading. Your patience, your discipline is everything when it comes to trading. If you're not willing to sit on your hands, wait for that A+ setup, or you get greedy in your trades, you're going to fail. And you got to make sure you lock in your discipline, or this just won't work, period. And you got to remember that with discipline comes patience, and patience is profit when it comes to day trading. One of the next most important things in the expectations and guidelines for this trading strategy is, first, we only trade during the New York trading session. The New York trading session is from 9:30 a.m. Eastern Standard Time or 6:30 a.m. Pacific Standard Time if you're like me, someone who lives on the West Coast. Make sure your charts are set to Eastern Standard Time. It just makes it much easier, so you don't have to try to, convert your time to the right time frame. Now, the other thing with this trading strategy, we are only trading one of two assets, okay? You pick either one of these, but these two assets work extremely well with this trading strategy. The two assets you're allowed to trade is either the S&P 500, which is MES or ES, or the NASDAQ, which is MNQ or NQ. Now, you can trade the micros or the minis. It's up to you. I always recommend people, especially if you're newer to trading, start with the micros, which would be the asset that has the M in front of it, so MES or MNQ. I recommend starting with those. You can start with a lot lower risk and really tailor every position you take and contract size you take. Now, the next most important thing in the expectations and guidelines of this trading strategy, you're only trading for 90 minutes a day. That is all you need. If the trade doesn't get set up, that's okay. Move on to the next day. You're only trading for 90 minutes a day. So that's at the 9:30 a.m. start to 90 minutes from there would be the 11 a.m. finish of Eastern Standard Time. The reason why I'm sending this first 90 minutes of the market open is where the most volatility happens and where the best setups take place. Now, also, we're trying to get rid of a 9 to 5. We're not trying to sit at the charts, sit at your computer for 10, 12, 13 hours a day, 5 hours, 8 hours a day, waiting for those setups. All you need is 90 minutes. And if you can trade for 90 minutes a day and be done and make your normal wage that you would have at a normal job, that will change your life completely. And that's our goal here. I'm trying to help you change your life for the better. And in reality, when it comes to day trading within a week, you really only need about 3 to 5 trades a week. And other people might tell you would take 3 to 5 trades a day. That is not sustainable. Trading that much does not help you with your P&L. Yeah, you might get some pretty big days, but I guarantee you're getting some really big losing days. So try to limit yourself. Take 3 to 5 really good trades a week instead of shooting for 3 to 5 trades a day. The reason why I'm giving you these guidelines and expectations for this trading strategy is because I'm trying to have you protect yourself from yourself. Because remember, I said we are our biggest enemy when it comes to day trading. Our discipline or undiscipline is what makes or breaks our trading, and is what makes us either unprofitable or profitable from getting that payout from a prop firm or even growing a live account that you have. Now let's talk about profit. Our profit is everything in the market and day trading, and we need to set some expectations on before we even get to the trading strategy of what do we need to do when it comes to profit. First, we do not execute trades unless the setup is there. Later on in this video, I'm going to give you the entire setup, the entire checklist you need, the 5 checklists that you need in order to execute a trade, and we do not execute unless the setup is there. Period. You do not make it or change the setup or change the strategy just because you want to make sure you take a trade today. Remember, 3 to 5 really good setups a week is all we need. If you're taking trades outside of the 1-minute kill shot strategy, you will fail. You're not following the strategy at that point. You're going on, you're gambling and doing your own thing. I'm giving you the strategy to follow, and if you follow it, it will work. And the slogan I like to live by, especially with my trading strategy, is patience is profit. Take a sticky note, put that on your computer, write it on the wall or something on a whiteboard. Make sure you look at that every single day. That patience is going to make you profitable. I promise you that. I've had to learn it. It's taken me 3 years to really master the art of patience. And I feel like I finally got a good grasp on it, but patience is everything in day trading. Real fast, we just want to let you know that we have a Discord server where if you want to join either free or premium access, where we trade live every single day. I trade this 1-minute kill shot trading strategy live every single day. If you want to join in on the premium Discord access, use the link down below and join up on our server. Right now, we are running a 20% off sale, so make sure you go lock that in before we raise rates. Now, before we actually get into the trading strategy, the 1-minute kill shot, I need to teach you 5 really important concepts that I have that if you don't understand these concepts, you're not going to really be able to take the trading strategy I've created and utilize it to the best of your abilities. Some of these you might already know, like a value gap is a pretty common term, or an inverse fair value gap, but I want to make sure each one of them you know as you're a beginner, so you can make sure you take these concepts and apply them to the trading strategy and are able to execute with excellence. The first concept I want us to master here is called impulse ranges. So let's head over to the charts, and I'm going to actually show you impulse ranges in the market and how do we identify them and what is the importance of these impulse ranges. Right now, we are looking at the 1-hour time frame on the S&P 500. Here is a really perfect example of an impulse range on the 1-hour time frame. As you can see here, we have a big leg up with no retracement, right? The retracement comes over here in this leg of price, but right here, there hasn't been a retracement yet. So how do we know that this is an impulse range? When you look left over here, you can see price broke this external range liquidity high. Price has broken structure to the upside. We've also broken above this high to the left here. And so we structured and had strong move up with no real kind of, this doesn't count as a retracement for me. This counts as a retracement. And so what is an impulse range? An impulse range is basically just a strong move in one direction, okay? An impulse range is when price will break structure also, like these highs over here to the left, and then you get a good leg of price that you want to see some kind of retracement, and this is where we would ideally look for a trade setup. Now, an important thing to understand with impulse ranges is this green area here is what's called premium. So when price is in a premium, and this red section here is when price is in a discount. Now, this line in the middle here is what's called the 50% line. Here are all my settings to actually draw this Fibonacci retracement tool to mark out an impulse range. Steal this however you like, make the colors however you want. Just make sure these numbers are the same. But the important thing with impulse ranges, anything underneath this 50% line is called discount, and anything above this 50% line is called premium. Now, if we are looking to take trades, say if we want to go long, right, and we're looking for price to do like this right here where it moves up, we want price to be in this discount before we take a long. And if we're looking to go short, we want to make sure price is in this premium before we go short. Anywhere inside this premium is where we want to target to then go to discount, where we can then potentially take longs. Now, what are the best time frames to look for impulse ranges? Personally, I love to look for impulse ranges on the 15-minute time frame, the 1-hour time frame, and the 4-hour time frame. Those are my ideal places to look for external range liquidity and impulse ranges to spot where to take my trades in the market. Now, the next concept we're going to be diving into is called external range liquidity. Something else you might have heard this as like swing highs or swing lows. This is what's going to help us identify where our take profit targets are and also where we want to see liquidity sweeps happen at. So now, how do I identify a external range liquidity level? Okay, how do I identify whether a low or a high is actually important in the market? And I'm going to explain to that right now. Here is a good example right here. We got both external range lows and external range highs that we can use as targets. This low here would be a great low to target for liquidity. As you can see here, price has come and tapped into this low and swept it and then had a nice push off of it. Now, why is this low right here so important where these wicks are? This low is very important because look what price does. Price pushes up and breaks above these highs to the left here. Now, also, we had a little retracement, and then what did price do again? Pushes up and breaks above these highs to the left here. You see that? So the only way an external range liquidity low is important is if that low pushes up to break highs to our left. So this is a valid low that pushes up here. This would be a valid low here because it pushes up and breaks above these highs to the left here. So as you can see, you can spot these external range liquidity lows. This low here. Why is that low important? Price broke above this high to the left here. Now, how do we identify external range liquidity highs that are important? You look right here in this leg of price, this external range liquidity high. Why is this high important? Because if you look left, it broke below this external range liquidity low because this low pushed up, made a higher high from this high to left. Then price came down, closed below these lows to left here, multiple lows, giving us an external range liquidity high we can target in the future. For example, this leg here that went and attacked this high as future take profit areas. Now, the next concept we're going to dive into, which is a pretty popular one, you might already know how to identify these and what they are, but I'm going to do a quick explanation of fair value gaps. A fair value gap is a 3-candle pattern with a space between the wicks, and that shows an imbalance in the market. For example, you have this bearish fair value gap right here. Why is it bearish? Because the candlesticks are moving to the downside. They've created 1, 2, 3 candle pattern with one fair value gap, leaving space between the 2 wicks of these candles. That's what a fair value gap is. Let me show you a bullish example just so you can see the bullish example of what a fair value gap looks like to the upside. Here is a bullish example of a fair value gap. You have a 1, 2, 3 candle pattern. Price has left the gap between this candle's wick and this candle's wick, leaving us that fair value gap. And look at what price did. Came and tested that fair value gap and gave a nice push off of it, giving a trade opportunity. Now, why are fair value gaps so important? Fair value gaps show an imbalance in the market where price had a rapid move up or a rapid move down. And we can use those imbalances for price to come and retest or disrespect and utilize as what's called point of interest on the chart to look for where we want to take this 1-minute kill shot trading strategy. Now, let me show you how to identify which fair value gaps actually matter. Let's go to the 1-hour time frame. And in this leg of price here, we see we have a fresh impulse range. In this impulse range on the 15-minute time frame, we can zoom in and identify some fair value gaps on the 15-minute time frame. Now, this impulse range is a bearish impulse range. So if we see price come back up to the premium of this range, we know we would want to look for short opportunities. Now, if we look right when price came back up into premium, we know we can ignore these fair value gaps down below because they're value gaps that are in either discount or they're in the lower portion of the premium range. And we want to see those higher level of fair value gaps that are higher in the premium to look for those opportunities to take a short off of. As you can see, price came up to premium, tapped into this fair value gap within premium, and gave us a perfect opportunity to go short and attack more external range liquidity. Now, same thing goes for this bullish example when it comes to fair value gaps and impulse ranges. We have this impulse range where price breaks us above these highs, but it hasn't really seen a retrace back down to discount. We see here price comes and retraces. Not only does it retrace into the discount of this range, but if you look left here, there's a 15-minute fair value gap. This 15-minute fair value gap could have been the area of interest you would have waited for to take that long, because not only is that fair value gap there as an imbalance, it's also in discount of this impulse range. And look at how aggressive that move is outside of that fair value gap. That's why you can ignore all these fair value gaps in this leg of price and wait for price to come back down in this discount and target one of these fair value gaps that haven't been utilized to have a big move off of. That's why it's important to understand impulse ranges and fair value gaps. When you tie those concepts together, they are extremely powerful. And that's what this trading strategy utilizes, what I'm about to teach you further on in this episode. The next concept I'm going to teach you is liquidity sweeps. How do we identify liquidity sweeps and why are they important for us to pay attention to? Here is a great example of a liquidity sweep on the 5-minute time frame for S&P 500. Now, I only look for liquidity sweeps on the 5-minute time frame. I don't look for higher time frames. I only look for the 5-minute, and then that's my signal for one of my confluences to take my 1-minute kill shot trading strategy. So let's look at this example here. What do we have to our left? First, we have this external range liquidity high. Why? Because this low starts to consolidate, pushes lower, breaking below these lows here, and continues to displace lower, attacking some of this external range liquidity down here. Now, what does price do? Price comes right back up and hits this high. Now, if this high would have been a spot for orders to have price push through, is price failed to displace this high. Instead, it left a really large wick off this high here, as you can see with this wick on this red here. That for me is one of my confluences that says price swept this high and instead of going through it, rejected off of it, which means price probably wants to go lower. As you can see, that's what it did. It ended up falling and going lower. So why is a liquidity sweep is important is because when price comes up here and taps into this high and fails to displace it, that means price just grabbed a lot of the resting orders that were sitting up here. Now, what does that also mean? That means a lot of the people that probably went long here down below us probably are getting trapped in their positions. So that means if we fail to displace this and we get a short opportunity to target these lows, we're going to get a very strong move to the downside because a lot of the people who went long are getting trapped, and that's going to be fuel for our position to go in the opposite direction of those traders. And liquidity sweeps give us that opportunity. Now, when you tie a liquidity sweep in with something like a fair value gap or impulse ranges, makes them even more powerful. Because if we zoom out here, price was in that 15-minute fair value gap we marked out earlier inside that big impulse range that we talked about, where price is in premium of that range. So when you tie those all together, it makes those fair value gaps and those liquidity sweeps extremely powerful. The last concept we're going to cover in this, which most of you probably already know, you probably have heard of before, but if not, I'm going to explain it, is an inverse fair value gap, which is like a disrespectfulness of a displacement or an imbalance on the market. Let me first explain and show you an example of an inverse fair value gap on the charts, and then we can get into the importance of them and how do we identify which ones matter and what else can an inverse fair value gap tell us when we're looking to take a position. As you can see here, price had an aggressive move to the upside. Now, what we also see here is in this move up, price made a lot of fair value gaps to the upside, which shows that price had a lot of momentum and a lot of imbalances that if price should come back down and test them, should respect them if it wants to continue going higher. But as we can see is price made all these bullish fair value gaps, but what did price do and show us in this leg of price down and inverted these fair value gaps? So what is an inversion? Let's zoom in on this fair value gap at the top here. An inversion is when you have a fair value gap and a candle closes through that fair value gap. So as you can see this red candle here, its candle body closed outside on the opposite end of the fair value gap, which is an indicator that price has inverted this fair value gap, which is also an indicator that price is disrespecting any bullish order flow and that the bearish order flow is starting to take over the market. As you can see here, we have this large fair value gap here. What does price do? Price enters the fair value gap and closes way beneath it. Not only does it close between this fair value gap, it also inverts this one too. That's now 3 fair value gaps that have been inverted on that leg of price down. This indicates to me that price has completely shifted, that it's no longer looking to go long, it's looking to go short. And now when you look at our example from earlier, the liquidity sweep up here, when you're looking to take that short opportunity, you can look left and say, look, price has not respected any of the bullish fair value gaps. In fact, it's inverted every single fair value gap in that leg of price. And then that actually confluence that says, okay, I can really start to trust this liquidity sweep and taking this short because price has disrespected all bullish order flow. And it looks like bearish order flow is really starting to take over the market and starting to get pretty aggressive, which means we can trust this leg down, not trust this bullish fair value up here that price most likely will invert it. As you can see, you would have gotten a liquidity sweep and then immediately price inverts this bullish fair value gap we see right here on the chart. Price inverted that fair value gap immediately. Okay, now we're going to actually do a full breakdown of the 1 minute kill shot. We're going to go into my TradeZilla and actually start doing a backtest section. And then I'm going to show you exactly how I execute my trades. Where do I put my buy or sell limits? Where do I put my stop losses? Where do I take profits? And how do I trail my stop loss in order to maximize my profit if a trade decides to go run and go even further? First, we need to set the expectation for pre-market analysis. This happens either 1 hour or 30 minutes before the market opens. You should, before you even come to the market open at 9:30 a.m. Eastern Standard Time, you should have all your levels marked out. You should have all the fair value gaps you're looking for marked out. You should have external range liquidity, session liquidity. Every single thing should be marked out. So when market opens, you don't have to like guess, oh, where was that fair value gap or which one was I looking for? It's all right there. And all you have to do is watch to see what the candles are doing inside those levels you marked out. Now, here's what your analysis rhythm should look like. You should start from the higher time frames and work your way down. Now, this is my every single day rhythm. I start from the monthly time frame and work my way down all the way to the 5 minute time frame. I don't go anywhere lower than the 5 minute time frame when it comes to my analysis. Now, the monthly time frame, I only go to that. I don't go to that every single day. I only go to that when the new month starts. Same for the weekly. I only go to the weekly time frame when a new week starts, but once you get those marked out, they're good for that rest of the week. Now, the day, the 4 hour, the 1 hour, the 15 minute, and the 5 minute, I go to every single day and mark out those levels. Here is everything you should be looking for on each time frame when you're going to mark out. Now, you can take a screenshot here, write them down however you want, but still this is everything you should be looking for on each time frame when you go to do your pre-market analysis. An important thing to know is Asia session and London session times. Asia session is 1800 to midnight EST, and then London session is from midnight to 6 a.m. EST. You're going to want to mark those low on the 1 hour time frame. That's where I mark out my session high lows. Of giving you breakdown of what it takes to do a pre-market analysis, let me show you what it actually looks like on the charts, and let's do a pre-market analysis before we show you a live trade. So right now I'm in my TradeZilla, and we're going to set up this pre-analysis. We're on currently the 4-week time frame, which would be the monthly time frame. So let's mark out some of these lows, which is a monthly time frame low. It's a monthly low. That's really the only one we need to care about. It's very unlikely that price is going to come all the way down to these lows. So we'll mark out that low for the time being. Now we're going to go to the weekly time frame. On this weekly time frame, as you can notice, we had impulse range here. So one, I mark out this impulse range here on the weekly time frame. So we're going to mark out our bullish fair value gaps here. All the bullish fair value gaps. We have 1, 2, and there's even a third one here. Now I will say this, when you get to the time frames of like the time frame and monthly time frame, fair value gaps that are higher in this range matter a lot more than when you get to like the minute time frame, because weekly value gaps are extremely powerful. And when we're on a time frame like the minute, that you could still catch a little retracement off of a weekly fair value gap. So it's a little different when you get to the weekly time frame when it comes to fair value gaps. Every fair value gap matters on the weekly time frame. Let's go to the day time frame. Now the day time frame also has a lot of impulse. This day fair value gap is pretty important too. We'll mark out this day fair value gap. And again, day fair value gaps are very powerful. So we don't necessarily care if a day fair value gap is in discount if we're looking to go long, because price can easily bounce off of that and get us a good trade, even though the fair value gap is in discount. What matters when fair value gaps are in premium discount are when we're in lower time frames like the 1 hour, 15 minute, or 5 minute time frame. What I forgot to do on the weekly time frame, we also want to make sure we mark out all the weekly lows and highs that are untapped. What matters the most is this weekly low here. We do not need to mark out this weekly low because this is the start of a new week and this is our current candle. So we don't want to mark out that one yet because the candle is still ongoing. So we only care about the ones that haven't been touched that are completely closed, which would be this low here that's on top of this weekly fair value gap. We want to mark out all these day lows and day highs that have yet to been touched in the market, because price, when they hit these day lows or day highs, will give a really nice reaction off of them because orders like to sit at day lows and day highs. So we want to mark out every day low between here and this weekly low. And we also want to make sure we mark out every day fair value gap. So now that we have every day low that has been untapped, we have those marked out. Those are all going to be important points of interest later on in our charting. So that's what we look for on the day time frame. We also look for all of our day fair value gaps. As you can see right here, we have this day fair value gap that has been untouched and this day fair value gap that has been untouched. Those are going to be important when we get down to those lower time frames. Now let's go down to the 4-hour time frame. Now the 4-hour time frame has a new impulse range we can utilize here. We have this low to this high here. So now we have an even lower time frame impulse range that we can utilize and take advantage of. And look at that. We have this 4-hour impulse range. Look what is sitting within discount of that range, that big day fair value gap. So that is going to be very important. And we also have a day low down here. Those are something we can potentially use in our trading that's going to be coming up in this trade. So now we are on the 1-hour time frame. And as we can see, price has session liquidity above us and below us. Right here, we have our London high session liquidity. We have a London high, we have a London low, and an Asia low below us. So we have a lot of liquidity below us, and we have a lot of liquidity above us. These all act as points of interest for us when we go to look for a trade. We have a London low, Asia low, a 1-hour fair value gap here, and some more external range liquidity below us. So maybe we can see price sweep this London low or Asia low to target London high, because London high is a very strong pool of liquidity when we're looking to target for a take profit. Now, when we go down to the 15-minute time frame, we also see that 15-minute time frame has a new impulse range. Where's that impulse range? This impulse range right here. Why is this an impulse range? We have this push up, price broke above these highs to the left. We have a retracement down, then a push up above where price breaks above these highs to the left again, leaving us an impulse range. Now, if we're going to take a long, we want price to be in of this 15-minute impulse range to take along to target London high. We're not going to try to shoot for something crazy. We're just taking those small, consistent profits. Now let's mark out some of these important 15-minute lows. We have this 15-minute low right here, and we also have this 15-minute low right here also. So these are all important liquidity levels that we can pay attention to if price decides to sweep any of those. Now let's go on the 5-minute time frame. That is the last time frame we're going to utilize. And we're going to spot any external range liquidity on the 5-minute time frame. And it looks like we have this low here, and we also have this high here. That we have identified all of our points of interest, right, which are fair value gaps, external range liquidity, all those things that we just talked about. We do not take any trades until 9:30 a.m. Eastern Standard Time. So we've done the pre-market analysis an hour to 30 minutes before the market opens. And if you're done with your market analysis, you can go make a cup of coffee. You can go get some breakfast before the market opens and wait for that 9:30 a.m. Eastern Standard Time candle for the opening bell. That means you can start taking trades. Now, once the opening bell happens, remember, we only have 90 minutes to actually take a trade. I want 0 distractions within that hour and a half. Put your phone away. Don't have anything else up on your desktop or your laptop. Don't have YouTube videos going. Don't have music playing. Just focus in on the charts for 90 minutes. Be extremely patient. Wait for the setups and only take the trades that you're supposed to. And we are extremely patient during these 90-minute trading session. We don't wait for another 30 minutes. Once that 90 minutes hits, we're like, oh, maybe that one's about to set up. No, 90 minutes. That's all you get. Be disciplined and walk away from the charts if you don't get anything. Or if you've taken the trade and it didn't work, be okay and come back tomorrow. So now here are the 4 confluences you need in order to take a trade, right? What we need to understand is price in a premium or a discount of a range, right? And remember, we only take longs in discount and we only take shorts in premium of a range, okay? That's a no break rule. Next one. One of our main confluences, is there a 5-minute sweep of liquidity? Those are extremely important. I went over liquidity sweeps. If you don't know that, go back and watch it. But we need to wait for that 5-minute sweep of liquidity. Now, what we also need to pay attention to, what you need to check off when you're looking for your trade is that trade within a point of interest? One of those session high lows, one of the external range high lows, a fair value gap. Was it in a point of interest, or are you just taking a random trade that you think works? And then the last one, do you have a 1-minute inverse fair value gap, which I'll show you how we look for those on the actual execution. Okay, so here's a list of confluences. Write this down, steal it from me, use it for your own trades. Now let's get into an actual execution of a trade. I want to let you in on up to a 90% sale that I have for just you guys, my subscribers, that if you use code Maniac at Apex Trader Funding, you will be able to lock in 90% off any prop firm you decide to buy and get access to one of the best prop firms in the entire industry. You can stack up to 20 accounts with Apex Trader Funding. Apex Trader Funding is my preferred prop firm. I use them personally. I have my own accounts where I am funded and have been able to lock in payouts and actually receive my payouts. So they're a prop firm that has been around probably one of the longest. They have over $500 million paid out to their traders and by far the best scaling opportunity in the industry. Use code Maniac, get up to 90% off when you go to sign up. Link is down below in the description. So now we're at that market open candle. It's 9:25 a.m. candle just open. Let's wait to see what the market gives us because remember, we are patient traders. The most important thing we can do is be patient traders. So let's look at where can we find an execution and how do we actually execute? And we're going to go over our confluence checklist that I gave you. So let's see how these candles form. Boom. We got a sweep of liquidity of these highs here. Not really interested in that. We're looking for a good long opportunity. Again, price is pushing up. Not really giving us any long opportunities, but what can I notice? Price has broken structure to the upside here, and instead of sweeping that liquidity, it's disrespected it. Now look what price is doing too. It's attacking these lows we've had marked out. Let's see what it does to these lows. Boom. Look what price just did. We have a major sweep of liquidity on this 5-minute low here, and look at the large wick that price gave us. Now, what can we also take note of? We can take note of that price also is in discount of this 15-minute range. So we can take the stab at this trade that potentially this trade could work. Even though it hasn't hit this London low or these 15-minute lows, we're getting that confluence of a major sweep of liquidity. We also have the confluence that price has broken structure to the upside. So we're getting a little bit of that retracement to where we can potentially attack this external range liquidity or that London high we have marked out up here. So now let's drop down to the 1-minute time frame. Now, when we go down to the 1-minute time frame, that same leg of price where price's broken structure created this one bearish fair value gap, right? Now, price has already shown a lot of displacement to the upside, broken structure. We've inverted fair value gaps all over to the left. So price is showing that potentially we're swapping order flow back to going long. And remember, when we look at a pre-market analysis, the weekly time frame was extremely bullish. The day time frame was extremely bullish. The 4-hour time frame was extremely bullish. So we're going with the trend. This is a high probability trade that we can trust. So let's see what happens on the 1-minute time frame. We're going to wait for this candle or one of these candles to invert this fair value gap. Okay, this right here has inverted this fair value gap. That is now our confirmation that we've gotten all of our confluences. Let's go back to our checklist and make sure we got them all. So first one, price is in a premium or a discount. Yes, we know that price is in a discount within the range. Next, do we have a 5-minute liquidity sweep? We do. We swept a lot of that resting liquidity below us, and we got a good sweep of liquidity on that. Are we within a point of interest? This one's not the best point of interest, but what we do have above us is the London high to target for a take profit, which is a strong probability that we're going to hit that liquidity because it's a session liquidity. Price likes to attack those instead of not leaving them open like that, especially in our majorly bullish bias of our trend that's in the overall market. Did we get the 1-minute inverse fair value gap? Yes, we got a 1-minute inverse fair value gap. So since we have all of our confluences marked off and we're able to take this trade, let's get trade set up for us right here. We want to put our buy limit at the top of that fair value gap that it inverted. So if we're going long, we want to put it at the top of this fair value gap that was just shown here. Our stop loss goes to this liquidity sweep below. Now, how do we target our first take profit? Our first take profit would be a 1R. We're going to take off 2/3 of our position. You're not going to get any greedy, you're not like greed from that. We're stacking small, consistent profits. And what's nice is look at where 1R is and look at where London high is, right? It's very likely price is going to London high. So we know that if price is most likely going to London high, we know 1R is most likely going to be hit here because we have even higher potential to go even further than our simple 1R trade. Execute our buy limit and let's see if we get tapped in here. All right, so we're now in our trade. Let's see how this plays out. We're going to make sure we set our partial TP at that 1R, and we're going to take off 2 contracts at that take profit. Okay, so we always take off 2/3 of our position at our first TP. We're going to sell 2 of our contracts at that high. Let's see if we can hit it. 2/3 of our position is off now, and we only have 1 contract running. So now that we were able to take off 2/3 of our contract size at this high, we have 1 contract left running. So now what we're going to want to do is move our stop loss to break even. Now, as you can see, price is displacing very nicely, leaving us a lot of fair value gaps. What we can also do is move our stop loss alongside this displacement that is happening on the 1-minute time frame. So let's actually move our stop loss to that first fair value gap. So we're going to adjust the position and move our stop loss to that first fair value gap. And we're going to hope that it hits that London high. Let's see what happens here. Okay, look at that. What did price just do? Price retraced a little bit on the 1-minute time frame. It also broke structure to the upside. Let's move our stop loss to this external range low on the 1-minute time frame. And if we also go to the 5-minute time frame, see what the 5-minute has created. The 5-minute is also creating an order block, and we can also trail 5-minute order blocks when we're letting that last contract run. So let's see what happens here on the 5-minute time frame. It gives us this order block. We can move our stop loss to this 5-minute order block, and look what it just hit. London high. I'm going to move my stop loss now to this 5-minute candle here that tested this 5-minute fair value gap and pushed really hard off of it. We can see how it ends up going, and eventually we're probably going to get stopped out as we just trail these order blocks and trail this position. And you get a really nice runner when you start trailing these order blocks. There we go. We now get stopped out, and that position we just followed just made us $4,260 on that trade when you just waited for that 1-minute kill shot and trailed order blocks and displacement as price moved. Now let's get into some other examples. I'm going to show you guys a short opportunity and then another long opportunity on the S&P 500. Let's zoom in. We have all of our point of interest marked out. Now let's dive into, do we get a trade opportunity? Okay, we have a potential setup going on right now in the market. What has happened? The 930 candle came in, was extremely bullish. Okay, now if we look left, we had all this liquidity. We had the London high, 15-minute highs, and what did price do? It blasted through every single one, and it kept breaking structure higher. So now we can delete all these points of interest because we destroyed every single one of them. But what do I notice here? When we look left on the structure and we go to the 15-minute time frame, we have a very large 15-minute fair value gap right here. Now, when we go down the 5-minute time frame, what do we also have when we look left? We have a 5-minute low. So not only did price create a lot of 5-minute fair value gaps, it created a very large 15-minute fair value gap after market open. It created a swing low that pushed above and broke this high to our left here, right? That break of structure here, creating this swing low. Look what price did. Price came down, swept this low. And if we go to the 15-minute time frame, we have this point of interest, this fair value gap, and we have this 15-minute impulse range. When we go down the 5-minute time frame, price came into discount, very tapped into this discount of this range and wicked out of it, failing to displace this low. That is a strong signal for me to look for a trade. Now, when we go down the 1-minute time frame, look what price did. Let's delete this 15-minute fair value gap because we know it's there, and let's pay attention to this fair value gap right here. What did price do? Price on the 1-minute time frame inverted this fair value gap, giving us a signal that we can try to go long. So let's open up our order book. We're going to take 3 contracts as a limit order. Remember, we placed our limit order at the top of that fair value gap. Stop loss goes to liquidity sweep, and then we set up our take profits. We set up this, liquidity sweep goes there, and we shoot for a 1-to-1. That's all. We're not getting greedy. We're just shooting for a 1-to-1. Now, we're not going to put that TP because we're going to set a partial up there. So there we go. We got the confirmation. Let's execute the order. And then let's also, once we get tapped in, we'll set our take profit. So let's see what happens on this 1-minute time frame. We get tapped in. Price immediately bounces off our inverse fair value gap. And let's set up that take profit so we don't miss it for that 1R take profit. There we go. Our take profit was hit. So now we'll move the rest of our position to break even. Or actually what we can do is move our stop loss to this 1-minute order block that's right here that broke structure to the upside. So let's actually, moving it to break even, let's move it a little higher to lock in profits just if it decides to come all the way back down. Let's see what it does. And we'll move up to the 5-minute time frame to see if the 5-minute starts giving us order blocks or anything. And there we go. We get stopped out on that. That with 3 minis, which is what you could trade on a prop firm, that trade made us $1,587.50. A great trade. And all we had to do was be patient for 90 minutes and take the trade that we needed, right? That trade happened after about an hour sitting at the market waiting for it. You had to wait an hour to make $1,500. The other trade we took, you waited about an hour also, and you made $4,300. And all you need is 90 minutes a day. Let's do the last trade example. Make sure you leave any comments down below in the comment section if you have any questions, if you're not understanding any of the concepts, some of the concepts we're saying. But let's do the final trade example. I'm not going to break down the entire analysis. We're just going to go to the execution to make it a little faster. But the next one is a short opportunity example that we're going to show you. All right, here is the next example we have, which is a short on NASDAQ. And here is the market open candle. This big red candle here that you see is the market open 9:30 a.m. Eastern Standard candle, which is what we wait for every single day, right? I told you guys, we need to wait for that 9:30 a.m. candle to start, and then we can look for our trades, and we are patient to wait for the right executions. Now, when we see here 9:30 a.m. Eastern Standard candle, we can also look, what did that candle do? That candle broke structure to the downside. Now that's not our signal to take a trade, right? And some people would jump into a trade because they see that it broke structure. That's not smart to do. We need to wait for the manipulation in the market. So now let's look at what the candle does. We have a push up, and look what the price does. It taps into this point of interest, this 15-minute fair value gap. It taps into this external range liquidity here and fails to displace that low. Now, what can we do on this 5-minute time frame? Look at how it fails to displace that low. Where the 5-minute time frame broke structure, we go down to the 1-minute time frame. Now, let's back it up a little bit because we're a little bit ahead of ourselves. Look at this candle. We're going to delete this line or shrink this line so it's out of our way and cleans up our chart. And we're going to delete this fair value gap because we know we're in that 15-minute fair value gap, which is a high point of interest for us. Now, look at here. What do we have right there? We have a inverse fair value gap. Now with this inverse fair value gap, same thing. We take 3 contracts. Same thing. We take our stop loss, move it to that liquidity sweep, and then we take profit and move it to 1R right there. So we're going to delete this one. And now we're going to execute this trade that we want to sell off 3 contracts if it retests that fair value gap. We're not going to market order. We're going to wait for the retest of the inverse fair value gap. So now price goes down. Price is messing around. It comes back up. It taps us in on this candle right here. Now we need to make sure we set up our take profit, which is 2 contracts. And we're going to make sure we have our buy limit of 2 contracts at that 1R from where our entry is and where our stop loss is at. And within 1 minute, boom, our partial TP gets destroyed. So now once our partial TP gets hit, we move stops to break even. Stop loss is now moved to break even. Let's see if we're able to let this trade run, or do we get stopped out at break even? So it looks like right after we hit our partial TP, we get stopped out at break even. And that's okay. We're not looking to catch the entire move. So with that trade, we got tapped out at break even. And even though we got tapped out at break even, we still made $475 on that trade with trading 3 mini S&P 500s. Small consistent wins is the name of the game. That is how you succeed in day trading and not being greedy. Most traders shoot for 2R, 3R, 4R trades. But if you shoot for 1R trades and consistently stack those wins, I promise you your accounts are going to grow. You're going to get payouts and you're going to see more profitable days day over day. Guys, that is my complete 1-minute kill shot trading strategy. I hope this video was helpful. Please leave any questions you have down below in the comments. We want to make sure we can help you out. Also, use the link down below in the description to join our Discord and join the premium access server where I trade live every single day and you can follow my trades live. Go check out that link and make sure you take advantage of any of the affiliate codes we have down below to get you deals on prop firms. But guys, I hope this video transforms your trading and you become a profitable trader. Make sure you like this video, subscribe, and leave a comment down below, and we'll see you in the next video. But before you leave, click this video right here if you want to learn how to use just $100 in a small live account and grow that to life-changing income.